Everything you knew about stability is a lie. From the wild optimism of the roaring 20s to the quiet complacency I see today, the US financial system is a loop of debt, disaster, and short-lived fixes. It's 2026, the doomsday clock is ticking. And if you're an investor, you need to understand this. The rules have changed, but the mistakes haven't. Let's rewind. Picture New York in 1929. Black and white chaos. Panic outside the NYSE. Fortunes evaporating overnight. The Dow Jones lost nearly 90% of its value from its peak, wiping out millions of investors. Why did it happen? Over-leverage. Everyone was buying stocks on margin, sometimes with as little as 10% down, hoping the party would never end. But when things turned, the Federal Reserve, barely out of diapers, froze. No help, no rescue. Banks collapsed, the money supply shrank by a third, and what could have been a correction spiraled into a decade-long depression. That's your first lesson. Centralized systems break down when leaders freeze. Fast forward, World War II ends. The Bretton Woods Agreement ties the world's currencies to the US dollar, and the dollar to gold. It felt like order, a stable anchor in turbulent times. But in 1971, Nixon breaks the chain. No more gold standard. The dollar becomes pure fiat. Fiscal discipline? Out the window. Suddenly, American spending has no leash. Wars, welfare, global ambitions, all funded by printed money. The national debt balloons and the world gets hooked on US dollars. By 1980, US national debt had tripled from a decade earlier. This moment didn't just change America. It rewired the global economy for cycles of debt and inflation. No gold leash meant easy credit and new bubbles. The dot-com bust, 2000. The Nasdaq lost 78% of its value in just 2 years. Suddenly companies with no revenue were worth billions, and hedge funds ignored the basics. When it all popped, leverage snapped back hard, defaults everywhere. Then the 2008 housing crisis. Banks, high on deregulation, built mountains of risk on subprime mortgages. The thinking? Housing prices only go up. But here's the reality. By 2006, nearly 1 in 5 mortgages was subprime. Lenders offered ninja loans, no income, no job, no assets required. People bought homes with zero down payment and no proof of income. These risky loans were bundled into mortgage-backed securities and sold around the world. When defaults surged, the entire global financial system almost collapsed. Lehman Brothers filed for the largest bankruptcy in US history, over $600 billion in assets. The Fed bailed out the banks, and too big to fail became the new normal. Risks were never punished, they were rewarded. In 2009, Wall Street paid out over $20 billion in bonuses, even as millions lost their homes. But what did we learn? After 2008, regulators introduced new rules. The Dodd-Frank Act aimed to increase transparency and reduce risk. Circuit breakers were added to the US stock market. If the S&P 500 drops 7%, 13%, or 20% in a day, trading halts automatically to prevent panic selling. Globally, banks faced stricter capital requirements under Basel III. Interest payments are now one of the biggest line items in the US budget. As the Fed hikes rates to fight inflation, old bonds lose value. That's a quiet theft from anyone holding them. Meanwhile, hedge funds are once again over-leveraged, this time in long-duration bonds, ignoring interest rate risk just like before. What happens when big buyers like China and Japan stop showing up? The Fed prints more, monetizes the debt, and the cycle of inflation and instability accelerates. We're not creating wealth anymore. We're recycling risk. So what do you do? The winners in 2026 will be those who stay aware and automate. Use technology to monitor risk and react faster than the crowd. Diversify globally. Understand the macro game. Learn from past crises. Don't put all your eggs in one basket. Don't get lulled into complacency by the same flawed system and familiar mistakes. Every crisis has left lessons and new rules. Use them. Subscribing here is your first investment of the year. I'll see you in the next deep dive. Stay ahead.